All right, so we are continuing on with our Apple stock research and analysis. Um, the video was broken up into two parts because I didn't want to have like one long video of like a 2 hour episode, right? So I broke it into two parts. So make sure you catch the first part if you haven't already before you watch this part, because then it's going to make sense and flow, okay? I've also linked it right here above the video. And so you can go click that and just go and watch it, okay? So moving on with the second part two of the research in terms of continuing with my financial rating of Apple. I gave it a 3 out of 5. And from an income profitability perspective, like I said in the previous, in the part one, there's no real issues or any problems there, right? They're making good money. Granted, 2023 was quote unquote a slowish type of year, and even when things are slow, they're still able to generate almost the same amount that they were generating when things are good and the consumer strong and they're able to spend more on luxury and frivolous items, right? And so the last 3 years they've averaged between 96 billion and 99 billion in net income consistently. The 5 years before this last 3 years, they were averaging between 45 to 57 billion, right? So that's a significant growth, and it's essentially they've doubled that net income opportunity. So that's exciting, and for that, from an income and profitability perspective, Apple gets a green flag. Okay. Net worth, which is what we spend more time on in terms of the balance sheet, that's where I give it a little bit of a red flag, because not because the company's not good or they're not doing the right things. They just tend to use their resources differently than what I typically would like to see or what I'm most comfortable with. Nonetheless, I'm okay with the risk of Apple, right? But typically I look for better balance sheet, if you will, right? The balance sheet is not bad, but it's not great in my humble opinion. Okay, so from a net worth perspective, the total current asset of 143.5 billion is slightly lower than the total current liability of 145.3 billion from the previous year, right? And so to me, this gives the company, this is a challenge, because technically their current liabilities is more than their current assets. And so if you have, it gives it a current ratio of 0.98, right? Meaning they can, based on their current assets, they can barely, right? They would just be able to cover their current liabilities. Like it would be like paycheck to paycheck, right? There won't be no extra money remaining or something like that. So to me, that's not something I'm particularly excited about. I prefer companies that have a typical current ratio of like 2 to 3. To me, that's healthy. That means they can pay at least twice, their current liabilities, because they have twice as much as current assets, right? So if you live in paycheck to paycheck, it's one. It's like 1 to 1, right? But if you're not living paycheck to paycheck and you're able to make more, then it can be something like 2 to 1, meaning whatever your short-term liabilities is, you can cover it twice over. To me, that's more comfortable, that's more attractive, and I know that from a risk perspective, I'm mitigating the risk of taking on too much leverage or challenges, right? If something is to happen, how are they going to mitigate the risk? Now, the good news is Apple do have $60 billion in cash, so that is good. That is nice. It can offset a lot of things, right? Almost close to almost I don't say everything, but most things that can come up, Apple can handle responsibly, right? I just don't like the fact that I prefer higher current ratio in general. Okay. And then in the short term, because of the high leverage, their dependency on debt is a little bit I would say more prevalent, right? And so to me, it's not that attractive if you have to kind of depend a little bit more on debt, especially in a volatile market and economic conditions that is very uncertain. So for that reason, in terms of current current ratios and stuff like that, I give it a red flag. The total long-term asset, we saw that was 209 billion, which is much higher than the total long-term liability of 145 billion, right? So obviously companies with higher long-term assets than liabilities are more favorable, right? They're more valuable, they do better fundamentally. And then stock price reflects that over time as well. And given the short-term debt challenges, I would feel more comfortable if the long-term assets were around 220 billion, right? So 209 billion is not bad, but if they can kind of manage to beef that up a little bit more, to me, it will help offset some of that current liabilities that I in the ratio here that I mentioned, right, it would help offset that a little bit more. And I would like that. I would like to see that if, let's say, the total long-term assets were 220 billion instead of 209 billion, that would make me a little bit more comfortable, because I know that mitigates a lot, at least 10 billion. It mitigates at least 10 billion of his current liabilities in a way, right? And also mitigate some of the long-term liabilities here too. So that's good. Now, generally, this in terms of long-term assets and long-term liabilities, little to no red flags with their long-term outlook, because it's in a healthy state. It's not bad, right? Total assets of 352 billion is only 62 billion more than its total liability. So that is where it's a little bit tricky, right? Because if you just got $62 billion more than your liabilities, I'm not particularly a big fan of that. And the good news is, the total liability has come down, right? It used to be at 302 billion. Now it's 290 billion. So, that's a decline of about 12 billion. So they are actually shaving it off over time. So I want to see that continue. If they can manage to consistently reduce that total liability and still increase the current asset column, and even the long-term asset column, now that becomes a lot more favorable. And that is some of the things that they're already starting to do in 2020, towards the end of 2023 and in 2024, which has led me to give them an overall financial rating of 3.3 out of 5. Otherwise, I would have probably given them 2.5, or maybe I still would have given them 3 out of 5. I think the 3 out of 5 is more conservative and being cautious of some of the unknowns and the things that some of the headwinds that can create an issue. Because, for example, if we run into a recession, guess what? Most people are not about to run out and go buy Apple products. They're just not, right? And then we have an election coming up, a lot of volatility. Nobody knows when interest rates are gonna, are gonna start getting cut. Nobody knows if inflation is really fully under control yet. So these are things that can affect all of these financials, and that's why I think I gave it a 3 out of 5, right? From a shareholder equity perspective, again, I'm not happy about that, because they're sitting at $62 billion compared to $50.6 billion previous year. Now, again, that's an increase, right? Somebody can look at it and be like, well, that's a 22% increase, which is a lot better than what it was last year, which is true, right? Because what it was in 2022, which is true. But 2022, it wasn't good at all. And just because it's better than what it was in 2022, it doesn't mean it's significantly better compared to its historical averages and where it's been at, right? So 62 is a right step in the right direction. They got to keep increasing that significantly over time, right? So it grew by 11.4 billion, which we're happy about. But overall, I expect Apple to have more of a shareholder equity that is, at least, in my opinion, they should and could comfortably get it to about 80 billion to 100 billion. If they manage to do that, and if you think the stock price is high now, dog, if they manage to get shareholder equity to about 80 to 100 billion, and they're able to keep lower the dependency and the leverage on debt a little bit, but continue making the money they've been making, or even increase that slightly, bro, that stock is going to double. And yeah, this is a prediction. If they manage to make these moves and work out some of these kings that I'm kind of highlighting, that stock is going to double. Right, already it is cooking, given all of its current state already, and its current state is not bad. I don't want you to misunderstand. The numbers tell a story, right? But there's also variables and different angles on the story, depending on how one looks at it. That's why it's never wise to look at one thing in one perspective and just assume you know everything, and you just make decisions off that one scope, that one tunnel. So it's good to always look at things from various angles and what factors are impacting us, and what is this telling us relative to what, what material impact can come out of this. So these are some of the things, you got to keep in mind. In my opinion, yeah, they can get to 80 to 100 in shareholder equity, bussing, stock doubling. All right. 17.6 of the total assets is shareholder equity, right? And that's what I was saying in terms of they're utilizing and leveraging a little bit too much debt. In my personal opinion, granted, they can handle it, but I would prefer that they wouldn't have to, because that means 83% of the business and a lot of things is basically funded by debt, right? Now, I would prefer if, like I said, if shareholder equity can make its way to even 30%, right, which is essentially kind of almost doubling, getting closer to that 80 to 100 that I was talking about. That would be huge because return earnings would improve significantly, and investors look at that, right? It's really how we measure the value of our shareholder equity, and that will directly impact the stock price. So hopefully they can sort that out and kind of manage the balance sheet a lot better. And it looks like they're doing better this year already, so that's good. Let's see what the next earnings that comes around in August is going to look like, and then we'll see what this looks like by the end of the year. So financial, 3 out of 5. Profitability is great, so that's good, and that's why I'm not extremely worried about where they sit in terms of some of these liabilities and shareholder equity amounts and how much they're utilizing debt, right? And now, if let's say income took a dive, if it went down by like 20-30%, then the material impact of this will be felt a lot more in the stock price. Okay. But for now, I think they're okay. I think their financials could be better, but they're just okay because they've shown they can weather this type of storm. They've done it time and time again. They've consistently done it and provided shareholders a lot of value, and they're making money despite difficult times. They're making nearly the same amount as they were making in good times. So, there's a lot of resiliency and something to be said about that. And so, yeah, I give them credit for that. Let's talk a little bit more about Apple versus its competition. Okay. This is important because these are key financial ratios, and this lets us know, right? Knowing about Apple is great, but how do they stack up against its competition, right? Like, how are they performing to some of the competition that I mentioned earlier? Okay, so from a gross profit margin, I give it a red flag because the truth is, if you compare Apple, Microsoft, Alphabet, which is Google, Amazon, and IBM, Apple's gross profit margin is actually the worst. Right, 45.59%. Amazon's at 47, IBM at 55, Google at 57, and Microsoft at 69. So from a gross profitability perspective, compared to its competition, right, Apple is not doing the best. And that's another reason why I think if they can kind of manage their liabilities a bit more effectively and efficiently, we can really see a huge change and turnaround in turning this green compared to its competition, right? That's what I'm talking about. Before, we're just looking at Apple by itself. Now we're looking at, its financial, some of the major financial ratios, comparing Apple to other companies that are in the same environment and industries. Okay, net profit margin, even though their gross profit margin not the best, their net profit margin is actually relatively good compared to its competition. Right, so they're sitting in second place right now at 26.3%, which is really, really good if you think about it. If they were 45 here, but net is 26, that's amazing, right? Because we see Microsoft at 69, but net is 36. So, do with those numbers what you will, but obviously net profit margin wise, Amazon and IBM at the bottom of the pool, at the bottom of the table, man, at the bottom of the league, Not like Manchester United. We somewhere in the middle. We're not at the bottom. But I think Apple has done a pretty good job overall. I still give it a red flag because I think they should be able to net a bit more despite everything. But relative to their gross profit margin and its competition, they're doing much better against competitors when it comes to net profit margin. I think they're doing as best as I think they can do more, but what they're doing right now is also great. However, I still gave it a red flag, not because they're bad, but compared to its competition, it's not number one, right? Granted, it's in second spot right now, so that's cool. But I would like to see Apple at number one. And that's gonna be tough because Microsoft is not no pushover. Them boys know how to make money, and them boys know how to keep money, right? So, moving on to the next slide, Apple versus competition. In terms of key financial ratios, again, when it comes to return, this is why, remember I said this video is going to be a bit contradictory, right? Because some parts of it, you're like, oh, yeah, this is great. This is not. Oh, this is good. It's interesting to see the blend together because when we look at some of the financial pieces, a lot of things from an income profitability perspective, good. Net worth / balance sheet perspective could use a lot of work, could use a lot of tweaking to improve certain pieces like I spoke on. But when we also flip it and look at, okay, what is the return on the assets? What is the return on the equity? What is return on investment? They're actually crushing that part, right? So that equity, that $62 billion worth of shareholder equity, the return on that has been incredible compared to its competition, right? They return 148.3%. That is incredible compared to everybody else that's sitting around here, right? So like I said, their ability to manage the resources has actually been good, right? They've proven time and time again that they can deliver, and they've been delivering. So yes, they are leveraging debt quite a bit, but it doesn't mean they can't handle it. And this is a good representation of exactly what I was talking about when I mentioned that. Right, so they're killing it here, 148.33. Nobody else even touching 50% from a return on equity perspective, right? So they get a major green flag on that. Same thing on the return on asset. They're doing great there too, almost 30%, right? The next in line is really around 20.7%, and that's Google, followed by Microsoft, Amazon, IBM, bottom of the league on that part, right? And so their return, even though their total liabilities is close, right? Even though their current liabilities is slightly more than their current assets, and total liabilities is close to their total assets, the return on all those assets though, right, even with that liability relationship, is still pretty good. Now, to be able to justify leveraging that much debt, these are the type of returns and numbers you need to be able to show and deliver, right? Because if you have all that debt and liability, but you're not delivering on that, then what is the point of leveraging all of that debt, right? It's like it becomes counterproductive, and it becomes a problem for investors. But again, Apple has been consistently able to show that, hey, yeah, they leveraging debt, they're using debt, they're doing this, they got cash going out a lot compared to the past, but this is the returns we're providing. This is how we know we're doing well, and we're backing it up. We're not just doing it and talking about it. It shows. Look at our competition, and then look at us, and this is what we see right now, right? So this is nice. Right. And then lastly, return on investment, like I mentioned. I mean, look at what the return on investment used to be in 2023 going into 2024. Right. So it took a dive here, but it used to be significantly higher. But despite that, look at this. Granted, most of these companies were also higher, right? And then now they took a dive. But where we're at today with Apple, they are crushing this thing. And it's beautiful to see, because 72.65% return on investment. That is why the stock price is where it's at today. Right, we've seen them taking a difficult, and all companies faced challenges in 2018 leading up, but the return on investment here has been incredible. Right, they blow the competition out the water. Blow it out the water. This I like. Right, so let's talk a little bit more about how has the stock price performed then. Okay, so we know that they're doing pretty well in terms of return on investment, return on assets, return on equity. So how is the stock price performance reflecting its financials, both from income profitability, net worth, balance sheet, return on investment, return on asset, return on equity, right? And that's what we're seeing completely over here at this particular moment, right? Apple is the blue, and we can see has returned 319% over the last 5 years for investors. That's incredible. Granted, all the competition has actually returned positive numbers as well, right? We have Microsoft, which is the green one. They've returned 231%, and then 207% for Amazon. For Google, and then followed by Amazon with 121%. And so these guys have all returned significant amount to investors, right? It's more than double, but Apple has basically tripled, right, over the last 5 years. So it is showing that yes, investors look at Apple, they're like, okay, yeah, all these things are there, but you guys are killing it. You continue performing. Your returns are showing. We see it in the stock price as well. It's reflected. We cool. No. Now let's look at Apple versus benchmark. Apple versus benchmark is incredible. Even more of a drastic gap between what Apple has been able to do versus the returns that people would have gotten from simply investing in the market, right? Again, individual stocks, some individual stocks are great, most are not, and it's very difficult to figure out which the great ones are. And you don't know if the great ones or the ones that provide a lot of returns will continue providing those returns in the long term, right? We don't know where Apple's going to be 5-10 years from now, right? So always take a lot of things with a grain of salt. But here, imagery wise, we can see the stock price, again, tripled, right? That's a 300% return, while the rest of the market, in terms of the S&P 500, the Nasdaq, Dow Jones, have returned basically between 125% all the way to about 45%. So that is what Apple has done compared to the major benchmarks, right? So obviously, if you put your money in Apple 5 years ago, it would have tripled. If you put your money in, say, the S&P 500 5 years ago, you would have doubled, right? Either way is win-wins. Some wins are bigger than others, but in terms of some of these returns, keep in mind with individual stocks, all these returns are not always the same like that. They don't always provide big returns all the time. There are times where you can have multi-year downturns. So just because Apple has tripled over the last 5 years, don't assume that it's going to be tripling every 5 years or something like that. Nobody actually knows, not even those on Wall Street. Okay. So from a technical rating perspective, in terms of return on assets, return on investment, return on equity, and then we just looked at is stock price return for shareholders versus its competitions, right? We saw how that gap was, and we just saw it as well with the benchmark. So with Apple versus competitors, they definitely have stronger returns, on its assets, and stock price compared to competitors reflects that as well. Its profitability, however, profitable, but like I said, when it comes to the balance sheet piece, I prefer a company that don't leverage as much debt, but Apple hasn't shown to mismanage or not use that debt effectively yet. You know what I mean? So they're still doing fine. So I give Apple versus competition a green flag on that. Apple versus major benchmarks. The stock obviously has outperformed by a huge margin. Good returns for one of the best returns for investors over the last 5 years. So that's great, right? And a lot of people think Apple will have a difficult time with this next chapter of innovation and growing and stuff like that. But I think Apple will surprise people. I'm a big believer that Apple will surprise a lot of people because they don't tend to be the first ones or be at the front of the headlines with the newest thing or whatever. They're not the first movers. They tend to be like second, third, sometimes even fourth movers. But the way they move, by the time they move, they've basically perfected it, right? All the kinks has been worked out already. They found a way to perfect the product, the service, the goods, whatever it is that they're providing, the value that they're providing. They figured it out and perfected it before they even come out. And the thing is, once they come out, they don't just come out and appease a small niche group. They're appeasing the average consumer, the average individual, the entire world population. That's why they have almost 3 billion people using Apple products, services, devices consistently on a regular, right? So they create things for the average person to use. That is very powerful. Some of these other companies in tech, they're creating products and services for other businesses to use because those other businesses are their consumer. For Apple, the consumers are literally the people. And that is a different type of cash cow, a different type of religion. We're so loyal to Apple and they have all the data. And guess what? If other companies want to benefit from that data and that ecosystem they have, they're going to have to pay Apple for that. So that's why Apple has some amazing, incredible income streams and they perform the way they do. So from technical perspective, I give them 5 out of 5. The numbers don't lie on that. The percentages, the key ratios versus competition don't lie on that. The stock performance doesn't lie on that. And we've seen it throughout time and time again. All right. So that brings us to the ending of the part 2 of this stock research video on Apple. And hopefully you enjoyed the video. Hopefully you learned a lot about Apple. And I wanted to paint a really important picture of giving you both sides of the coin, both the good, the great, and then also the areas where you want to kind of pay a little bit more attention, be cautious, ask some questions, and know that these are some challenges and risks and headwinds that the company also faces. So hopefully I was able to analyze and align and bring both of them in a way that makes sense for you. I know sometimes these videos can be a little bit tricky if you're somebody who's not from like a corporate finance background or know exactly what you're doing when it comes to individual stock research. That's why I take the time and the energy to actually do the work, bulk of that work for you. And so you can kind of use this as a springboard to learn more and catapult into more research. And so if you enjoyed this video, make sure you subscribe. If you haven't subscribed already, give us a thumbs up, turn the notification bell on. If there are any specific videos you would like me to cover, any specific stocks you would like me to do research on, or any other financial videos you want me to kind of make, give me a shout. Put it in the comments. More than happy to do so. And don't forget, make sure to follow us on Instagram, Twitter, Facebook, and anybody that's not investing yet. If you want to learn and begin investing, you can easily open a Robinhood account simply by clicking this link, which I'll have it in the comments as well. The Robinhood, join Robinhood.com /Godford B1. That's a link that will get you started, help you create your account, and it doesn't matter. You can start learning about it, learn about investing, learn about some of these funds that's available, some of these stocks I've covered as well. And even if you manage to begin investing $50 a week, $50 every 2 weeks or a month is better than zero. Hopefully you enjoyed the video, and I'll see you in the next episode. Stay tycoon. Cheers.